Ladies and gentlemen, boys and girls, are you ready for another rendition of Mr. Ray's Real Estate? We talking about making millionaires, baby. Sound check. Lila, we sound okay?
Sounds good.
Right, let's get this party started. Let's get into it. Today, we are going to talk about a very, very important subject. It has to do with financing your property. Now, we've been talking about this BRRRR strategy, baby, where you buy the property. And this is a buy and hold strategy. You buy the property, you rehab the property, you rent the property, you refinance the property, and then, ladies and gentlemen, you repeat it. That's called the BRRRR strategy. Let's get into this thing, baby. This is another Thursday rendition. We all know what the ground rules are. Make sure that you keep your phone muted and make sure you keep your camera off during the formal teaching part of the presentation. Please ask your questions over in the comment section. And then as usual, I do need your feedback on how I can make it better. I want to talk to you before we get into our lesson about a little sermonette that's been on my heart and mind this week, because I think this is where we sometimes get tripped up. And I got tripped up even this week on this issue right here about worrying about stuff that may or may not happen. Anybody worry out there? Do you worry about things? Well, we need to talk about that today, because there's something inherent in worry that is not, it's not of what the Lord wants us to do, because he tells us the exact opposite. So let's go to the word and see what doth saith the Lord. And he's speaking to us here in Matthew. He says, I want to tell you something. I want to tell you, you don't need to worry about your life. Come on now. Somebody, he's saying, you don't got to worry about your food, your drink, your clothes, what you're going to wear. I mean, isn't life more important than food, and your body more important than clothing? But we worry about these things. How are we going to pay our bills? How are we going to pay the car note? And how are we going to have enough food? Will I have clothes on? We worry about things the Lord is telling us here you don't really need to worry about. He said, don't let your hearts be troubled. You get all caught up in worrying about things that may or may not happen. Believe in God, he said, and believe also in me. Oh, you know, he said, in my Father's house are many mansions, baby. If it were not so, he would not told you so. But it's all about, don't worry. He's got this. The more you worry, the more worrying that you do. It begets more worry. But at the same time that we're worrying, sometimes we are fearful. He said, but you don't need to fear, because I'm with you. Don't be dismayed, for I am God, and I got this, baby. You don't have to worry about anything. Oh, you get so excited and you're tossing and turning at night and you can't sleep and you're driving down the highway, and all you can think about are your problems and your fears. And he said, don't, there is no fear in love. Come on, somebody, because perfect love casts out fear, because fear involves torment. You're tormented in your fear, but he who is fearing, oh, he's not made perfect in love yet. God has to perfect you in love. You got to know that he loves you, and he first loved you even before you love him. He's got this, baby. Don't be fearful, he says. Be strong, he says. He wants you to be courageous. Don't be afraid. Don't be discouraged. The Lord your God, he's with you, baby. He's with you wherever you go. You may not feel him. You may not even understand this scripture, but these are his promises to his people. Don't be scared. I don't care what they say. Don't be scared. The Lord is with me. the psalmist says, I will not be afraid. What can man do to me other than kill me? And if he kills me, I'm going to be with the Lord. What am I fearful about? Why do we get fearful? Because our minds have not been cleansed properly by the blood of the Lamb. You don't know who you are. You're fearful because you're not dependent on his word. You're dependent upon your performance to get things done. I got to make this happen. No, you don't. It's all about him. It's God who's working in me to do according to his will. And then you got to be happy, baby. Why you got to be happy, Mr. Ray? Because he gives you specific promises. He told you now, don't worry, don't fear, don't do none of that. What I need you to do is trust in me, because you know what? No weapon formed against you is ever going to prosper. Oh, no, it won't. It cannot. Because he will protect you. That's what he do, baby. He's in the protection business, because he said, I am the Lord, and I know that the Lord is my shepherd. I ain't got to want for nothing. Huh? Why do you worry? Why do you fear? The Bible says, God says, I got this. Cast all your cares on him, for he cares for you all. Nobody cares for you like the Lord. Why are you worrying, baby? Take it to the Lord in prayer. He will cover you with his wings of love. Don't be anxious. Oh, come on now. Here's where we got to go. He said, but in everything, did I say everything? I meant everything. You got to take everything in prayer and supplication. Don't forget to thank him. And then let your requests be known to God. Oh, come on, somebody. You got to be happy. You got to develop a different mindset. You have to have a positive mind. I keep telling y'all, this millionaire thing, it ain't all about the money, baby. Because if you get the money and you don't have the right mindset, all you're going to do is be broke again. You got to have a positive mindset. As a man thinketh in his heart, so he is. So everything that you're thinking, all this worry, all this fretting, all this fearing, all this doing is causing more of it, because like attracts like. And so when you're fearful and when you're worrying and when you just don't know what you're going to do, all you're doing is drawing more of that to yourself. You got to come out of that, baby. You got to have a positive mindset. Bible says in Philippians, they said, think on these things. Whatsoever things are true, whatsoever things are good, whatsoever things are noble, whatsoever things are love, whatever these admirable things, think on these things. Don't let your mind just be wondering, just let anything in your mind. You got to be the captain of your thoughts. You got to take control of what you think about, baby. He said, be ye transformed. How am I going to do that, Mr. Ray? He said, by the renewing. You got to renew your mind every day. Every day you get up, you got to have a mindset. I will, I shall, I'm going to overcome. I am God's chosen one. I'm surrounded by him. I can do. God has got my back. You have to transform your mind. Who's going to do it if you don't? You got to get away from all these negative people telling you all this negative stuff. All you doing is feeding into what the devil wants to do. He wants to bring you down. Oh, but God, he wants to bring you up. He wants to transform you. He wants to renew your mind. And as a man is what he thinks about all day. Come on now. What do you spend the majority of your time thinking about all day? That's what you are. That you are the sum total of all the thoughts that you have thought about up until this point. You can't blame your situation, your circumstance on who you are, on anybody else but you, because it is a proven fact. You are where you are because of your mindset. Can't blame it on mama. Oh no, you can't blame it on daddy. All them workers, are they talking about me? Or nah, none of that. It's not what happens to you. It's how you respond in your mind to what happened. Oh, come on, somebody. I wish I could preach this, but it's a sermonette, baby, and I gotta keep it short. But think on these things. Think. Be transformed in your mind. And then lastly, I got to end with a racism. And then we're going to get on into this lesson of refinancing. It all comes down to this, baby. Oh, you got to trust in the Lord. Come on now, with all your heart. Don't try to do this thing on your own. Don't try to, this real estate thing or whatever it is, business that you're doing. Don't lean to your own understanding. Go to him in prayer. Acknowledge him. Guess what? He gonna give you the path, baby. He gonna show you straight way. Here's where you need to go. Here's what you need to do. But you got to spend time with him. You think spending 4 or 5 minutes in prayer in the morning or in the evening is gonna get it. Then the rest of the time you can go away and think about and do what you gotta do. No. You gotta spend some quality time with him. Oh, I wish I had a praying church right here, because he will transform you in your mind, but you got to give him your heart, your soul, your mind, your body. You got to give it all to him, baby. That's the Rayism for today. All right, we got to get into this thing, baby. We got to talk about what we got to talk about, because we're talking about the BRRRR strategy, right? And in the BRRRR strategy, over the last few weeks, we've talked about how you buy the property, right? We went through all of that. We talked about how you rehab the property. We talked about that one on last week. Today, we're going to talk about how you refinance the property. And then next week, we'll talk about how you rent the property. So let's get into week 11, refinance. Now, this is one of the key pieces of the business. How do you do the refinance? So we need to talk about, how do we finance our BRRRR property? How do we get the financing? So I need to talk about a few things that you need to make sure that you got when we talk about financing. First of all, we're going to talk about cash reserves and why those are required. And then we got to have a good credit score. How is your credit score? Do you even know what your credit score is? I promise you, your banker knows what your credit score is. And then we're going to talk about something you may or may not ever heard about this. It's called it's actually called the DSCR. It's the Derby set. It's kind of the debt to income ratio. We'll get into it. I got to explain it to you because it's very, very important, because the lenders want to know that you can afford this debt. And then we'll talk a little bit about how do you apply for the loan. Okay, let's get into it. So the bank has requirements. You say, well, Mr. Ray, I got the property bought. I got it rehabbed. I got it rented. Now I need to go and get it refinanced. So what is the bank going to be looking for? What are the requirements that the bank's going to be looking for? Well, the bank's going to be looking for a good credit score. Well, what's a good credit score? Good credit score is anywhere between 600 and 800. We're going to talk about what's included in that credit score and how you can make that credit score better. The bank's going to want to have a statement of cash on hand. How much cash do you have in your bank account? They're going to want to see that before they give you the loan, because they're going to require you to put at least 20% down. Okay, so you got to have that, plus you got to have what I call reserves. Then you can't be having a whole bunch of delinquent accounts. Now, some of y'all ain't been paying your bills on time, and it's going to show up. Everything that you do on your credit, whether you buy a car, loan, credit cards, whatever, if you're late, guess what? It's recorded, and it's going to be reflected on your score, and it's going to impact you when you go out and you try to get some credit. And then you got to make sure you got that down payment, baby. We talked about the cash. They want to verify that you have this cash in the bank, and it ain't just you just run down and put it in the bank. You can't get a loan on it. You got to show that this money has been in account for at least a couple of 3 months. And then we're going to talk about this debt service coverage ratio. This is key, because the banks are going to determine whether you can pay your bills or not. So let's get into this thing. And I'm going to give you a chance to ask some questions on each one of those. But I'm going to go through each one a little bit at a time so we get this. This is very, very important. So why, Mr. Ray, do I need to have cash reserves? And what are cash? Cash reserves are just, you got to have cash in the bank. This is cashola, baby. I'm talking about the bag. I'm talking about the payola. I'm talking about chips. You got to have the money in the banks. Why do I need reserves? Because cash reserves are going to help you cover unexpected expenses. Oh, you're going to have some unexpected things happen. Things just happen. We're talking about a house, right? And there are maintenance issues, and you got to have enough money in the bank to cover those expenses. Cash reserves, how much should I have, Mr. Ray? You should have, for each property that you should have a minimum of 3 months worth of rent for that property. So if you have a property that rents for $1,000 a month, you need to have set aside $3,000 just for that property, okay? Cash reserves should only be used in case of emergency, in case something breaks down. Don't go get in that money because, oh, you know what? I'm running short over here in my household expenses. I need to go borrow that because I'm going to put it back later. Don't do that. Because the minute that you do that and you deplete that fund, you're going to have an emergency. You're going to have an expense that you're going to have to pay for. And you can't just run down and say, well, I guess I'll go get a loan. No. You got to do things immediately. A lot of times when these things break, air conditioning, plumbing, heating, stuff like that happens, you got to have the money on hand to take care of that and get that fixed for your tenant. And hey, I love this right here. Cash reserves will allow you to sleep at night, baby, knowing that you got some extra cushion that you can take care of emergencies as they arise. So let's go back to that. I'm gonna stop right here and ask anybody got any questions on cash reserve. Pretty self-explanatory, right? Okay. Let's keep going then. So what's your credit score? Well, your credit score is determined by several things, and we're going to walk through that. But a good credit score, you want to be anywhere from, you want to be, this one says about 630 to 850, right? Anywhere above there, the banks are going to want to deal with you. If you're down in the 300 and the low 600, you're going to have a hard time getting any bank to want to talk to you because it's indicative of your ability to pay your bill. Let's look at what makes up a credit score, Mr. Ray. Well, your credit score is made up of several things. The biggest part of your credit score is your payment history, right? If you have late payments, that's going to drive your score lower, right? So you got to make sure that you pay your get bills on time and that you don't never skip a payment. And then 10% of it is like, what types of credit do you have? You have mortgages, student loans, credit cards. These can boost your score, especially if you're paying on time. And then they're going to look at what kind of history have you got? Have you shown that you've been responsible for managing your credit over a long period of time? The great thing that I have is that I've been doing this for over 20 years. So I've been working on my credit for 20 years or more. So I make sure that I maintain at least 750 or more credit score because I know that if I need the money, the bank's going to look at my credit score and say, yeah, we can trust Mr. Ray. He's never been delinquent. He's never been in bankruptcy. He's never filed anything. He is legit and we will lend to him. And then make sure you don't have too many accounts. That makes up 15% of your credit score. The more inquiry, every time you go and apply for credit, that's called an inquiry, and that lowers your credit score. So you want to make sure that you're not doing it, especially if you're trying to buy a home, and this is your personal home. Make sure you're not out there doing a lot of things that's messing up your credit because they're going to be looking. You out here looking at trying to buy this, buy that. They're saying they want you to be stable. So make sure that you know that not many inquiries should be happening on your credit, especially when you're trying to get a mortgage. And then keep the amount owed under 30% of your limits, right? If your credit limit is $1,000 on your credit card, don't have it maxed out. Keep it about 70% of that, okay? Any questions on what makes up your credit score? Good stuff, good stuff. Let's keep going. So what can I do, Mr. Ray, to boost my credit score? Well, you want to make sure, like I said, pay your bills on time, reduce the amount of debt that you got. and get rid of any negative information that's on your credit report. Once a year, you should be checking your credit to see if there's anything erroneous on there. And if it is, you need to work with the credit bureaus to get that corrected. You get a free credit score every year. And anytime that you put in for credit, you have the opportunity to go in and get a free copy of your credit report. And so I suggest that at least once a year that you go in and you take a look at your credit score. All right. Any questions on the credit? Covered a lot of good information here. I'll be posting this, so you'll get a chance to go back and to look at this. So let's talk about.
Hey, Mr. Ray.
Yeah. Sorry.
I'm sorry, sir. What ways do you track and look at your credit score? Do you use free sources?
Yeah, I just use the free sources, right? I use Experian, there's three major ones out there, and any of those are the ones that I use. Experian for the most part. Do you have others that you look at?
Oh, yes, sir.
Transamerica is another one, I think.
Yeah, TransUnion, Credit Sesame, and Credit Karma.
Yeah, and so when you look at all those, are they pretty much the same?
No, TransUnion is usually higher than all of them.
Yeah, so the banks are going to use TransUnion and they're going to use Experian. So those are the ones you really need to be looking at, because those are the ones that the banks are going to be relying on. Any other questions? Pay off some of that debt. Make sure you pay your bills on time, and make sure all your accounts in good standing. If you got any negative information, make sure you get out there and get that cleaned up. So let's talk about debt service coverage ratio. This is very important. The DSCR is the measurement of your ability to use the cash flow that you're making from your properties to pay your current debt. That's all it is, okay? So banks use this as a measure to determine whether the investment, which in this case is going to be real estate, is going to make enough cash to pay the debt, okay? That's all they're interested in. And so they say, we want to see what this coverage is, right? And so lenders like to see a coverage between 1.1 and 1.4. That means you have the ability to cover the debt one time plus a little bit more. So I'm going to give you some examples of how we determine what that debt service is. For example, if you have a DSCR of 0.95, that means you're only making 95% of the money that's needed to pay your debt, okay? So they're saying you're not making enough money. You need to make at least one time enough money in order to cover that debt. Any questions on this? I'm going to show you a few examples on how we figure this. But any questions at this point? Okay. Keep moving. So here's the formula. It is the net annual operating income divided by the total debt service. And when the debt service, we're talking about your mortgage, okay? So let's look at an example. Let's say we have this house we're renting for $1,000, and then we have the principal and interest, the taxes, and insurance, vacancy. After we deduct all of that, at the end of the day, we have net cash flow of $166 on this a month, right? So that's $166. After you pay everything, $166 goes in your pocket. So let's figure the DSCR on this example. So same example, the only thing that you do is take out your principal and interest on your mortgage, right? So they say after you pay all of your other stuff, everything except your mortgage, what do you have left over basically to pay the mortgage, okay? So in this case, you have $759 of net operating income that's left over to pay the mortgage. So here's what here's what the formula look like. So you'll take the 759 and you divide it by the mortgage payment, in this case, which is 593, and you'll get a DSCR of 1.27. So that's a pretty good one. That means you're making $759 to cover at least that. So you're covering it by 1.27. And so lenders are normally looking for, like I said, between 1.1 and 1.4. So anywhere in there, you'll be good. Any questions on the formula? All right, let's keep it moving. So the next thing we want to talk about is actually applying for the loan. What do I need? What do I need to know before I go down and apply for a loan? Now, I've checked my credit score and looks like it's good. I looked at the net cash flow of the property that I'm thinking about buying. Looks like I got good debt coverage. So I'm going to the bank. I'm getting ready to go. What do I need when I go in and apply for a loan? So you need to be prepared to have this information ready when you apply for a loan. You got to have a personal financial statement, including your driver's license. When I say a personal financial statement, it's basically an application. It's going to show where you live, what your social security number is, how many homes you have. It's going to have a balance sheet, all your assets, all your liabilities, everything is going to be on there so the bank can identify and determine who you are and what your financial your financial picture at that particular moment, right? So it's a personal financial statement, and they normally will give you an application and it'll have everything on there and you'll just fill it out. How much money you made, how many bills you got, etc. So be prepared that you're going to have that information. And you're going to have your last 2 years tax returns. You say, Mr. Ray, I didn't file my tax return. Well, that's a problem. The banks are going to want to see your tax return. So you got to make sure that you have your tax return, because that's going to help them determine how much money that you made over the last 2 years. And then you're going to have the last 2 months bank statements, and probably if you're working a full-time job, you're going to have your last 2 pay stubs, your W-2 pay stubs. They'll want to see that also. And then if you have an LLC like me, they'll want to see your articles of incorporation. They want to see a certificate of good standing. They want to see your EIN number. They want everything that has to do with that LLC to verify that you are in fact the owner and that you are certified to have a corporation operating in the state of Oklahoma. Any questions on what the banks are going to be looking for in your application? All right. So I've given you all that good information. So now I need to show you what a good BRRRR would look like from a financial standpoint. So let's look at it. So let's look at some assumptions that we're going to make. Let's just assume we're going to buy this property January 1, 2022. We're going to assume that the after repair value is $100,000 just to keep it clean. And we know that banks will loan up to 75% loan to value. And so the loan to value, I got 30,000 here. That should be 70,000. Excuse me on that. I will get that corrected on the slide. Let's assume again the cost of repairs is 20,000. The monthly rent's 1,000. It's going to take you 2 months to rehab it, and we're going to have to hold that property 1 year before we refinance. That's called seasoning. The banks like to see that you have a tenant in there for a year before they will turn around and refinance it. So here we have $100,000. Let's say the value of this property is $100,000. We're going to take out 20 in repairs. We're going to assume that we got to leave 30,000 in it because the bank's only going to finance 70% of it. So we got 30,000 that we're going to have in what we call loan to value. So the total purchase price on this particular property is going to be 50,000. Now, you say, Mr. Ray, do I have to have cash? Well, you're going to have cash. You're going to have hard money loan. You're going to have private money. You're going to have to something. And the BRRRR, when you're doing BRRRR properties, you're not using the bank's money up front. You're using your money, or you're using personal money, or you're using hard money loans, right?
Hey, Ray.
Yeah.
Is that calculation still correct if you said that the LTV should be 70K?
Well, that's what the bank's going to loan them, but I'm saying the 30,000 is what you're going to have as far as what I want to say. That's part of your equity that you're going to have in the property, because the bank's only going to finance 70,000. So the 30 is correct. That's what you're leaving in. So your total purchase price is going to be 50,000, which is 50% of the 100K. So let me just change this right quick, so I can make the slide right. Okay, so they're only going to loan you $70,000. Okay, so you're going to have 30,000 is still in the deal from an equity standpoint. So all you're going to be willing to pay for this property is $50,000. Does that make sense?
Yes.
Okay. All right. So let's keep going. So now we're all in for 50, right? 50 plus the 30. We're all in for 80K. I'm sorry, I made another mistake. You guys, when I get to going too fast sometimes, let me redo this real quick. All right, I think we got it right now. Let's try this again. So we got 20,000 in repairs. So we paid 50,000 for it. We got 20 in repairs. So we got 70,000 in the game. The 30,000 is still the equity that's in the property. Okay. Sorry about that confusion, but here we are. So we bought the property for 50,000. We put 20,000 in repairs. So we got 70K in the property. Okay. So let's keep going with my assumption. Right now, we're all in for 70K on a $100,000 property. So let's assume that we're going to complete the rehab in 3 months. It's going to take us 3 months from January to March to complete the rehab. Let's assume the property, after we complete it, we're going to go ahead and rent it out a month later for $1,000. And then we're going to assume we're going to refinance it a year later, right? So the bank is not going to let you refinance it as soon as you get it rented. They're going to say, we like you to have a renter in there for 6 months to a year. Let's assume we wait a year. And we're going to refinance 75% at 5% for 15 years. So this is what it's going to look like. So after the rehab, it'll look like this. So we go in, we get the property appraised, it comes back at $100,000, just like we said it would. So at 75%, we refinance it. The bank gives us a $75,000 back at the refinance. Now, that's cash back. Remember, we had 80,000 in it. So we got everything back but $5,000 when we refinanced it. Okay. And remember, we had net cash flow of, I think it was 166. Well, if you multiply 166 times 12, you get 1992. So your net annual cash flows divided by the 5,000 that you have left in the house, because you got your 75,000 back, leaves you with a 39% return on your money. Okay, that's the BRRRR strategy. Let me stop right here and go back a minute. Just make sure we got it. So we said the property is going to appraise for 100. We're going to buy it for 50, and we're going to put 20 in repairs in. So we're in for the 70,000.
Mr. Ray.
Yeah.
So can you go back right quick? Why are you adding the repairs twice? Seem like.
Why am I adding the repairs?
It looks like you're adding the repairs up there, and then you for the all in. Why are you adding the repairs again?
Well, I'm just showing you I got 50,000 plus the 20,000. That's the cash that I have in it. This is not a cash deal. The 30,000, that's what you're leaving in it as far as the equity in the property. This is the cash out of pocket. 50,000 is what I paid for it, 20,000 in rehab. That's all I got in the game, 70,000. Does that make sense?
Your formula showed 80,000 as the all-in figure. When you go ahead 2 slides.
Oh, I'm sorry, it should be 70. I had 80 on that. So I did get all my money back. So this slide right here.
Yes.
Good catch. So we got the 75 back. And so now we got 75K back. And so we actually got, put it back here. So after the refi, let's go back to this again. All right, so we're all in for 70. And this is the beauty of the BRRRR. We're all in for 70. When we refi it, we get 75,000 back. I'm sorry, I did have the wrong number. It is 75K because we're refinancing at 75%. So we're getting all our cash back plus 5,000. So what's the return on that, Mr. Ray? Well, if you got all your money back, you get infinity return, right? So that's what the BRRRR strategy does. It allows you to get all your money back and then to go back in and redo it again on the repeat. So let me show you that in actuality. I'm going to come back to my final thoughts here. This is a property that I bought. This is 1805 Ballard Drive, 3-bed, 2-bath, 2-car, 1,600 square feet. I purchased this property in June and I paid 110 cash for it. The rehab cost was $30,000 and it took me a couple of months to rehab it, and I rented it in September 1 for $1,200. I refinanced it in April at 5% for 15 years. The property appraised for $165,000. So if you take 75% of that 165,000, hold on, 165 times 0.75 should be, man, I messed up all my numbers on this. Should be 123 cash back, but I only took 115 out of the deal, right? So the bank said, Mr. Whitley, we will give you 75% of that 165, which would be $123,000. But I only took 115 of that because I wanted my monthly payment to be lower. So I left 25,000 in the deal. So of my money that I had, what I have in cash, I had 110 plus 30, 140,000 in cash. So I got 115,000 of it back, and I still got 25,000 in the deal. So it wasn't a complete BRRRR. I still got money in the deal, but I got most of my money back, and I can still take that 115,000 and go back and do another deal. Any questions on that? This was a pure BRRRR deal that I did. Normally, you want to get all your money back, but even if you don't get all your money back, you're still doing a good job because you're getting most of your money back. And you can turn around and take that money and go do the same thing again. And that's how you build your repertoire of properties. Any questions? This is where you can get in trouble on the BRRRR. When you overestimate the ARV and the monthly rent. We just tend to do that. And I've done that, and I just got burnt on a property because I overestimated what the ARV, back when the market was really hot, I thought I could get a lot more money for the property, and I overestimated the ARV, and the ARV came in a lot lower, right? And then also on the monthly rent, make sure you don't overestimate that. You say, oh man, I know I can get 1,200. Well, if the rent in that area, in that neighborhood is only 1,000, then you really need to be very careful that you don't overestimate that. And then also don't underestimate the cost of the repair and the expenses. We tend to do that. We want to underestimate, oh, I can get it done cheaper, or I can cut corners here, and then these will get you in trouble when you're doing the BRRRR strategy. And then finally, make sure you do your due diligence and make sure you understand all the costs that are going to be involved, because sometimes you'll have carrying costs. I mean, as you're fixing the property, you'll find out you got to have expenses that you got to pay for utilities. You got to have the utilities on to repair. You got to have the property, like Darren said earlier, you have to have the property insured as you're working on the property. So all these different costs, you got to make sure that you understand your all-in costs that you're going to be having to pay as you're holding this property for rehab. Any questions? All right, so we went through this. Any questions on my BRRRR here? So what are the benefits, Mr. Ray, of going through all this? What are the benefits of the BRRRR strategy? Well, it's a wealth building strategy because you're buying a property and you're holding the property, and the property is going hopefully appreciate in value. That is, if you bought it in the right location, that property is going to appreciate. So that's one benefit that you're going to get. The other benefit that you're going to get is you're going to get the benefit of the depreciation expense deduction on your taxes, which is a non-cash event. But what it does, as every property is depreciated over 27 years per the IRS. So every year you get to deduct 1/27 of the value of that property and write it off as an expense on your taxes. You're also getting the benefit of the principal pay down. As you're paying off that loan and as the value of the property is going up, your tenant is actually paying down that loan over the life of the loan. And so they're paying that for you, and that's building up equity in the property. And then you're getting the monthly cash flow. So you're building wealth 4 different ways, and that's the beauty of the BRRRR strategy. Any questions on the benefits of the BRRRR strategy? These are great benefits. There's no other asset class that can do this for you other than real estate. You can't get this in stocks. You can't get this in bonds. Only real estate affords you the opportunity to build this type of wealth using this type of formula. So final thoughts. The last class for this session is going to be next week. I'm going to be taking a break. After next week, we're going to be talking about the final issue that we're going to be talking about in the BRRRR is going to be, how do you rent the property? And so I'm going to be taking the month of October off. So don't send me any money. If you're a paying customer, don't send me any money for the month of October. I'm going to determine what I'm going to do after I take a month hiatus. Okay. But I will be available during this month to answer any questions that you might have